Hey, good evening, everyone. Good evening.
Good evening,
Good evening,
Professor.
Professor.
Yeah, how
Good
are
evening,
you?
Professor.
Candice, Awa, and Devin. Alrighty, so I see how many people? I'm seeing 11 people here, and in the discussion board, let me quickly check. Okay, I see 12 people in the discussion board. All right, so okay, Elizabeth Bardo has just joined us, collaborate. So we have 12 here. Oh no, actually 14 people here. Um, so it looks like I have more people in the collaborate session than in today's forum. So don't forget, if you are in the collaborate session and haven't signed into today's forum, please do it ASAP. Okay. Now, so in our last class, right? Uh, so we were just touching on the real option. Of course, uh, we touched on the real option, and the so as an example, we looked at types of real option. First of all, quite obvious, expansion, right? Expansion. Quite obvious thing is expansion option, right? If the demand turns out to be excellent, we might need to expand. I mean, increase in like if the demand increases by 50%, would you miss out on that opportunity? No, we'll need to expand. But expansion requires more equipment. I mean, if we are currently at our maximum capacity, if we are running at our maximum capacity, or even if you're running at like 85% capacity, it can't meet 50% increase in demand. So we have to expand. Expansion requires commitment of new resources like capital, more capital, right? More labor, more resources, right? So we looked at, so in our example, it requires additional commitment of $1 million in year two. So in year two, if you remember, the cash flow uh, in year two was $4 million. Why? It was originally 5 million, if you remember. It was originally 5 million. Okay, let me use, everything is in thousands. So you might wonder, oh, isn't it 4,000? No, uh, everything is in thousands. So that means 4 million. But why was it 4 million? Because we needed, originally it was uh, 5 million, right? Expected cash flow would be 5 million, but we have to uh, make investment of 1 million, right? That requires, to receive, 5 million cash flow in year two, we required, right? Investment of 1 million. That's why in year two, 4 million, and then 5 million in year three. So expansion requires additional commitment. Uh, and then there is investment timing option. We talked about this, so I'm not gonna go over this again. Abandonment, investment timing, flexibility. But in expansion, there are two things, two types of expansion. What is required in expansion? First of all, think about it. If we don't have, we can we can put in more production line, we can put in more equipment, if we have space, right? In other words, if we already have some, slack in space, if we have, additional space, then all for expansion, all we need is just, $1 million in um, additional $1 million investment in equipment and, in other words, capital, right? But if we don't have a space, then that's a problem. $1 million cannot be even invested because there's no room for new equipment. So something like this, I mean, if we don't have a space, we need to consider uh, um, adding additional space. But adding additional space, this must be planned already at the beginning before time 0. Isn't that right? But how do we know if it's going to be useful? I mean, what if the space isn't going to be um, what if there is no excellent demand or anything like that? What if well then we just simply waste and if the additional space could be built uh, at the beginning at the beginning of the construction of the plant at the cost of $500,000, that would be that can be considered. But then what if there is no excellent demand? So this has to be planned ahead. Then this additional space will simply be wasted. So we need to know whether this additional space will be worth it, right? So to do that, it's basically a cost-benefit analysis. It's basically cost-benefit analysis. So here, here's the that scenario. Consider Wingfoot's situation after the possibility of excellent demand is as described in example 12.3. Example 12.3 is, oops, that's not. 12.3 is, yeah, it's like this. That's 12.3. Is there a real option? Is a real option present? The answer is yes. I'm gonna get to that later. B, so it's a two-part question. B, suppose space at Wingfoot's plant is scarce and room for an expansion is available only at 0.5 million at the project's outset. Yeah, this is what I explained. You can have expansion if there is already excess space. If there is excess space, then all you need is additional investment of $1 million for putting in new equipment, more equipment, right? Capital goods. However, if there is no space, then we have to build it. We have to build this, include this additional space at the project's outset. At the project's outset, in addition to that 1 million in year 2. If the project's initial that means the project's initial outlay, in other words, C0, right? Initial investment will increase by 0.5 million if this expansion option is included. If demand isn't excellent, then money will be wasted. So our question is, will the benefit from this expansion will it outweigh the cost, which could be, if it is if benefit is greater than the cost, it's not totally wasted, right? It's not going to be totally wasted if benefit is greater. So should we include this additional space at the outset of the project? So let's take a look. So we have to answer two parts, right? It's two-part question, as I say. Is a real option present? Second, should we include this additional space at the beginning of the project? So the first part A, we're going to answer part A. Wing's factory, Wing Food's factory is at full capacity. In 12.2, Wing Food's factory is at full capacity and a sales level consistent, at full capacity at a sales level consistent with good consumer acceptance of the new product shown along the top. We know, we've seen that tree diagram. If expansion isn't possible, however, if expansion isn't possible, in other words, if expansion isn't possible, there is nothing management can do to take advantage of higher expected demand. And in 12.3, the firm has the option to invest additional 1 million in an expansion if larger demand is experienced. The project could generate more sales and increase the rise in cash flow that might more than offset the cost. In other words, is benefit greater than the cost, right? The opportunity to respond to the excellent consumer acceptance by expanding the plant is a real option. Yes, the answer, real option. Management has the option to expand capacity at an incremental cost to meet the higher expected demand. Incremental cost, 1 million, right? However, so far there is no cost associated with this real option, right? Actually, there was cost, I don't know why the book said no cost associated. This 1 million is not an option. It's just if this option will be possible only if we have this option will be feasible only if we have additional space. So this is not the cost associated with the option, but it's cost associated with expansion. Let's take a look at the implication of the real option in case we choose to have this option of building excess space, additional space. So having extra space from the beginning gives the real option. Yeah, without the extra space, if you don't have any space, if you had space, yes, the expansion, you can do that by additional 1 million. But, if you don't have space, so it gives the real option to expand. It's really real in the physical sense, right? Without it, management has no choice. So to decide whether to purchase extra space, we have to place a value on the ability to expand. Okay? And compare that value with the cost compare that with the cost of option, which is 0.5 million. Okay, that's the cost. So we want to know what is the benefit with this expansion. Benefit. So how do we then? The cost is already given, 0.5 million. How do we assess the cost, the benefit of the this option? We'll have to compare expected net present value with option and expected net present value without option. Okay, so the difference will be the value of the real option. The difference will be the value of the real option. So in our example 12.2 was the example without that option. 12.3 is the example with the option. So expected net present value with the option is this. We found, that's the result of, right? And then without that option, without the expansion option, 12.2, right? Net present value from 12.2, which is the which is an example with without any expansion, right? So the difference between the two is the value of the option, right? Difference between the two is the value of the option without option. So the difference, 419, is the real value of the real option. But this value of the real option is less than the cost, right? The cost is 0.5 million. So then this is not worth taking, right? This is not worth pursuing. Always, benefit must be greater than cost. Then, that's the concept of basically NPV, right? So this is how you can evaluate the expansion option. Management shouldn't buy the space for the potential expansion ahead of time. However, there may be another reason to consider keeping the expansion option alive. There may be a reason to consider keeping the expansion option alive. Okay, why? So let's take a look at the next example. So poorly performing project can be abandoned. Yes, I mean, it's better to abandon it than, keep it up. And then the plant and equipment may be better used elsewhere. In other words, what that means is cash flow, cash from the sale of plant and equipment, right? Oh, if this, project isn't living up to expectations, then yeah, we can sell that and then use the cash elsewhere. It also takes planning to preserve. So this is called abandonment option, and so let's take a look at this. So Wingfoot has other lines of shoes in which most of the equipment purchased for running shoes project can be used if the new idea, the expansion idea, right? Expansion. If the new idea is abandoned, if the new idea, the expansion is abandoned. So in this case, you don't have, they are not really liquidating. They are not really liquidating the plant and equipment for the running shoes, but they convert they use the plant and equipment in other product line, right? The plant and equipment is used in other product lines. And then so in the first year, management estimates that at the end of the first year, the equipment value in those other uses will be 4.5 million. Yes. At the end of the first year, the equipment's value in other uses will be 4.5 million. How does this information impact the analysis? So if it turns out to be bad, then we salvage the equipment, or use it for other purpose in other product lines. So if it turns out bad, there will be no second year, third year, right? There will be no cash flow in year 2, year 3, right? It will be used in other product line. So that means, the lower branch, the bottom branch, it will generate cash flow only in year 1, and then no cash flow in year 2 and year 3, right? If the project is abandoned and the equipment is redeployed, abandoned and equipment redeployed at the end of the first year, cash flows along the bottom path would be 6 million in the first year, and 0 in year 2 and 3 because it's abandoned. The net present value along the bottom path would then be, okay, the present value of that. So in other words, think about it. If it flops, right? It doesn't work. If it doesn't work, right, then there will be no year 2, year 3, right? And then the equipment redeployed equipment will add, right, 4.5 million to because anyway in year 1 there's cash flow, and this cash flow 4.5 comes from other product line, okay? But anyway, that's cash flow at the end of year 1. Of course, you need to discount it to present, right? 2 times 0 unit. So then overall, with the abandonment option, with this option still, included, with this option still on hand, right? Or in hand, right? If you recalculate the NPV, right? If you recalculate the net present value all over again, so if it is excellent, net present value will be like this. If it is good, net present value will be like that. Poor is going to be like that. Probability of excellent, this. Probability of good, this. Poor, this. So these two, they don't change. I mean, they are the same as, right? But think about it. This turns out to be without the abandonment option. Think about it. Previously, what was the bottom branch? What was the result of the bottom branch? The result of the bottom branch is negative. As I said, the top branch and the middle branch, or the lower upper branch, that doesn't change. It hasn't. It's still the same thing. right? It's still the same thing. Still the same thing. But the bottom branch has turned into positive, right? So the expected net present value is much greater than previously expected net present value was 1.388 million. Now this is 2.078 million, right? So abandonment is an option available to the management that improves the project's NPV, right? Abandonment option improves the project's NPV, right? And it's a real option. If abandonment is possible, it's a real option. The existence of an abandonment option lowers the project's risk substantially, right? There's no, negative an original project had a 40% probability of negative 40% original project had 40% probability of negative net present value. But such a loss could ruin a small farm and a reason to avoid the project altogether, right? Yeah, that could be a severe, right? However, if the abandonment option exists as described, loss becomes a 40% probability of small gain, right? Loss turns into a 40% probability of small gain. So it makes the project as a whole, a lot less risky. And it's unlikely that a firm would need to avoid the project. Yeah. So the firm wouldn't reject the project because of this probability risk of ruin. Okay. So real options can be worth than their impact on the real option can be worth more than their impact on net present value because it reduces risk. In other words, this is not a big gain, a small gain, but overall, it's a small gain, right? Small positive, but it doesn't improve. It's much better, of course. Net present value is much better than, but not just because of dollar value of the net present value, but also because of 40% probability, averting 40% probability of failure or ruin, or converting 40% probability of negative return into even a small positive return. In all three scenarios, in other words, in all three scenarios, there is no loss in all these scenarios, right? And that reduces the risk significantly. That's why abandonment option is valuable. It generally reduces risk. Okay. Now, however, not all rear options have a risk effect. I mean, risk effect is kind of tricky. To mitigate risk, an option must improve. First of all, to mitigate risk, it must improve net present value, right? And reducing that potential loss is worth more than, I mean, that's why real option is uh, uh, why it's important. And the reduction of potential loss is more important than making success better. Okay. In other words, in this example, profits are higher if things go really well, of course. But there was still a 40% chance of big loss. But this big loss has turned into positive gain, right? Okay. So then how do we think about it? Everything, all these, first of all, two things we wonder. Oh, so how do we generate cash flow? That's the second, future cash flow. How do we generate that? Um, it's more of a counting thing, but it's just, making, we already know if we have certain, average growth rate over the past, we can, use it to extrapolate. Uh, but, second, discount rate. So 1 plus R, all net present value all present values depend on what this R is, because if the R is off, if the R is completely off, right? Think about it. If the discount rate is completely off, or if the discount rate is too high, net present value will be too low. If it is too high, even the profitable projects will become a unprofitable project with a lot of loss. Or if the discount rate is too small, even the risky projects will come out as acceptable projects. So how do we determining that cost of K, it plays a key role. We all understand it plays a key role. That's why we talked about, we did, weighted average cost of capital, right? We know for net present value, K is used as the discount rate. A higher K, we already talked about it. Higher K leads to a lower NPV, reducing the chance of project. For internal rate of return, internal rate of return is compared to K. So a higher K leads to a lower chance of project acceptance, right? So we know how to. There are three methods. We already did it in cost of capital. There's risk premium method, there's CAPM method, and Gordon model method to to determine cost of capital. Of course, we already understand riskier projects should be less acceptable, right? So we start with the starting point for risk-adjusted rate. The risk-adjusted rate comes from CAPM, right? To really adjust for risk. But the starting point is the firm's current level reflected in its current cost of capital, And then using risk premium, right? We already know if it is debt capital bonds, right? Debt capital, the structure of the interest rate is basically the base rate plus risk premium. Risk premia, actually, because there are four types of risk. One is, default risk. 2, liquidity risk. I mean, if you did liquidity, if you did, Finance 100 with me, you should remember this. And then what they call maturity risk, or it goes by 3 names: maturity risk, interest rate risk, and or price risk, right? So in capital budgeting, right, the higher risk, for higher risk, you need higher risk premium. In capital budgeting, of course, company is the investor, because company is pursuing, company is running multiple projects, because if you think about it, a company is a portfolio, because whatever the company does, the projects that the company is undertaking, they are all, each project is like an asset in a portfolio, right? And then so if you add risk premium, right, we already understand risk premium. If it is just replacement, if it is just replacement, it's the lowest risk. So just use the cost of capital. Companies, existing cost of capital, current cost of capital. However, if it is expansion, slightly riskier than the current level, because we understand if you expand, but then actual demand may not really live up to the expectation. Then so that's the risk. Or add 1 to 3 percentage points to the current cost of capital. We talked about this already. If it is a new venture, this is the most the most risky. So we have to using weighted average cost of capital method we already covered in the previous chapter, right? We can handle, we can find the right cost of capital for the new venture. And as I said, sometimes portfolio theory can help, which is basically that says project is a diversification of the risk that the company is taking, because a company takes, if the company is engaged in a lot of projects, multiple projects, each project, every project has different expected return and different internal rate of return, and different risks, right? A new venture certainly diversifies the firm more. New venture also diversifies the stockholders' investment portfolio. Yeah, not only for the company, right? New venture diversifies the firm, but also through the company, vicariously, the stockholder diversifies his investment portfolio. And we understand that the from Finance 100, you understand risks are diversified into systemic risk and non-systemic risk, right? Risks can be not diversified, but classified into systemic risk and non-systemic risk. Non-systemic risk is diversifiable. Systemic risk is non-diversifiable, right? Some risks are diversified away within the firm's portfolio. That we already discussed that. Some risks are diversified away by the shareholders' investment portfolio, and the remaining risk is only the systemic risk. Okay, so systemic risk actually comes from, I believe I talked about this in the last class, financial market risk, this means financial market risk, and then interest rate and reinvestment rate, interest rate, reinvestment rate, and inflation and exchange rate risk. Now think about it. Financial market risk, interest rate risk, reinvestment rate risk, inflation risk, exchange rate risk, these are all systemic. In other words, coming from the economic system. There's nothing you can do about it, right? Whereas diversifiable risks are firm-specific risks, firm-specific. And they are financial risk and business risk. Now you might wonder, oh, financial risk, isn't that, I mean, isn't financial risk, is the financial market risk? No. Financial risk is not is different from financial market risk. What is meant by financial risk is the debt level, leverage, right? How much debt is the company using? So in other words, capital structure. If the capital structure is like 60% debt, 40% equity, I mean, the higher the leverage, the more financial risk that the company bears, right? And depending on the industry, some industries are prone to be more highly leveraged. Okay, some industries are prone to be more highly leveraged. Now you might wonder, is it, does it depend on the industry? I mean, isn't it just firm specific? Some companies can be more. Look, borrowing money, of course, you can sell it, sell stocks. I mean, if you are a company listed in the stock market and bond market, you can sell bond. But even selling bond, the lender, in other words, bond holder, bond investor, will look at the capital structure of the company, because if the company has high debt level, the chances of this default or going bankrupt, right? The probability of bankruptcy and default would go up. And who's going to buy such a bond? I mean, such a company will have low credit rating in the first place, low bond rating, right? So obviously, that's not going to be a very, it's not going to be a very marketable bond. And borrowing money from the bank, from the, think about it. If you have, no bank will be willing to lend you a huge amount of capital if your capital structure is already something like 60% debt, 40% equity, right? So financial risk means leverage, right? And it's quite obvious. The higher the leverage, the the chances of default risk is going up. So that's also called financial distress. Okay, financial distress is going up. So I already talked about this. So I already said this. How do we estimate risk-adjusted rate? Uh, CAPM. Okay, I'm not going to go over CAPM again. So if a project is viewed as a business in a particular field, use a beta common to that field, right? So if it is a new venture, right? New venture. I mean, why would you worry about beta? If you have, I mean, if it is just expansion, you'll use just 3% risk premium. If it is a new venture, yeah, you can use like 5% risk premium, but you want risk adjusted, um, risk adjusted, risk uh, uh, discount rate. So because it is a new venture, and so you look at the average beta uh, for that field, right? And when an independent publicly traded firm can be found, right? Use that as the new venture. That's called pure play firm. What does that mean? A company X, let's say, um, does nothing else but only this, right? A company X does, so if you can find such a firm, right, its beta can be, that's called pure play firm, right? It doesn't do, for example, if you look at Samsung, Samsung has so many divisions and so many product lines. Samsung is not only making TVs, all consumer electronics, computers, and cell phones, and a lot of IT devices, a lot of so Samsung even so Samsung Electronics alone makes even a refrigerator, washer and dryer. So Samsung is not a pure play firm. Samsung is not a pure play firm. On the other hand, something like Nokia was a pure, relatively. Nokia is no. I don't, think we have Nokia anymore. But Nokia was relatively a pure, compared to Samsung, pure play firm because it was only making, or rather, RIM, Research in Motion, which was a Canadian company that made uh, BlackBerry. That's the company that doesn't exist anymore. But it was a kind of uh, pure play farm, right, compared to Samsung. So here's an example for new venture. Using how we estimate risk-adjusted discount rate, right, required return through uh, for new venture. So Orion Inc. is a successful manufacturer of radio communications equipment. Management is considering producing a sophisticated tactical radio for the sale to the Army, but is concerned because the military market is known to be quite risky. The military radio market is dominated by Milrad Inc., which holds Milrad, which holds 60% market share. So this is pretty much, the big guy in the market. Another company, Antex, is another established competitor with a 20% market share. So both Milrad and Antex make only military radios. So they are like pure play, only military radios. Pure play, right? So Milrad's beta is 1.4 and Antex's beta is 2. Well, obviously, because Milrad is a bigger company in the market, so their risk is lower, so beta is lower. Antex's beta is higher. Orion's beta is Milrad's beta. Antex beta is 2. Orion's beta is 1.1. But obviously this will, because currently they are not in the military market, but if they go into the military market, then this beta will have to go up because they are a newcomer. And it's, for a newcomer, it's a risky venture because existing competitors, the biggest player won't like it. Second player won't like it. They don't want any competitor, right? Even everybody wants to become a monopoly, isn't it right? If possible, you don't want to have any competition. So they may try to kill off Orion. Of course, if Orion is only military, Orion is not doing military market, but as in the civilian market, and they may be a big company, so they may not. I mean, looking at their beta, that's pretty much average size company in the industry, right? In the civilian market. So Milrad cannot, or Antex cannot easily kill off Orion, but they will definitely make it tough in this military market to compete. So currently, return on average publicly traded stock is about 10%. So market return is 10%. Yield on the short-term treasury bill, risk-free return is 5%. Orion's weighted average cost of capital is 8%. So that means we need to use CAPM. But then what beta do we use? What beta? So most likely we will use, because you're a newcomer, rather than 1.4, maybe you'll use, Antex. Antex is beta. So so the military radio project is expected, so in other words, to use CAPM, right, to find, right, what beta to use, right? We know this, just 5%. We know this, 10%. So what would be the discount rate, appropriate discount rate or required return for Orion, for going into, right? You cannot use this beta because this current beta, this beta is not for military market, right? So the project is expected to require an initial outlay of 10 million. Subsequent cash inflows are expected to be 3 million per year for the next 5 years. Okay. Should Orion undertake this project? So it's all a matter of, discount rate. So Um, military radio business is riskier than Orion's current business. So Milred and Antex, both pure play firms, right? But Milred probably has less risk than it is the market. Orion will be similar to Antex. So use beta of 2 to evaluate the pro. So then, so Orion's cost of capital, right? That KOO Orion's 5%, CAPM, right? Beta 15%. Using this as the discount rate, now net present value. So we know the drill, right? Basically, what happened? Um, I don't have time to open a new. Let's see. Let me open a. But you get, so it's like this: C0, C1, C2, C3, C4, C5. Initial investment 5 million, right? Oh, 10 million, I'm sorry, 10 million. Initial investment 10 million. And then 3 million, 3 million, 3 million, 3 million, 3 million. And we just find the present value of this, right? Using 15% as the discount rate. So then if you do that, yeah, we come to a positive net present value, but not very great. Just about 100,000. I mean, if it is $100,000 over 5 years, is it worth really going into that? Since the net present value is barely positive, right? The project is marginally acceptable at best, marginally, right? Um, if we evaluate it at current, Orion's current, you can, first of all, you wouldn't evaluate it. You wouldn't evaluate the project. You wouldn't evaluate the project at Orion's current 8% cost of capital, because this is not for military market, right? Although net present value would be like that, but that's obviously wrong, right? So this is basically how we evaluate real option. And okay, so let's do this. So this is, remember how we found net present value with the benefit of, in other words, value of the real option, right? Value of the real option. This was the example we did last time, right? Excellent, good, poor, right? So here we have, net present value of weighted average net present value, weighted average net, or expected. Expected means it's the weighted average, right? Expected net present value, right? We know this is the without, what's going on? What's happening? Why is it? Oh, my hand is touching it. So this is, net present value without the option, without the real option, right? This is the net present value with the real option. Writing it is so. With the real option. So the value of the real option is the difference between the two. Yeah, that's the difference between the two, right? That's only, 419,000, right? And the cost of real option is, so here, I already, this is something we got already, right? Something like that. So the value of the real option is this, and we need to compare it with the cost of the real option. And then, of course, net of real option will be negative, right? Or it's already negative, so I'm gonna have to, right? So it's negative, so we don't do it. And 12.5 is what? I don't know what 12.5. Did we have example? Oh, here. Okay, let's do this. So does everyone have this open in front of you? Everyone has this open, this file, this Excel file?
Yes.
Okay, only one person. Who was that? Only one person said yes.
Awa.
Awa, okay, Awa. How about the other people? Ajbola, are you there, Ajbola? Ellen?
Yes,
Are you there?
sir. Yes,
I'm bringing it
Professor
up
Ho.
here.
Yes, we
Okay,
do.
good, good. Ebony, yeah, only 4 people. It looks like only
Yes,
4 people.
I'm here, Professor.
Elizabeth, are you there, Elizabeth? Jared is there. Jasmine, are you there? Mukamajan, are you there? Nazir, Serena?
I'm here.
Okay, so it looks like we're still missing. Okay, Elizabeth there. So let's do this example. It should be easy because now pretty much the same example, but what is the difference? With the abandonment option, right? Why do you see why 6 million here? Because this is the case when we redeploy. If running shoes fail, I mean, then you can redeploy that to other product lines. So, and then there is no cash flow in year 2, year 3, if it turns out poor. But if it turns out great, excellent and good, so pretty much this thing is the same. So I want you just do this with me. So present value, cost of capital is there, and you have to lock it because we're gonna drag it down, raise to times digit, and then, which is not difficult. It's just, drag it down like that. And of course, the red is only reserved for the negative, right? Or cash outflow. So you change the font color to black. Net present value is sum of all of that. So, right? Sum, okay. And then probability weighted net present value, probability in year 1, probability in year 2 times this. Okay, and then the same thing, of course. I'm gonna just copy this and make some adjustment because it's going to be pointing to the wrong cell. First of all, here, D38, yeah, A35, no, A35 is there, correct. C38, no, it should be like that, right? And then, okay, you drag it down, okay. And the probability sum, the probability is, yeah, got it. Now, I'll just copy this, these two only. It's not C38, we know A38, A39, okay. It's 0, so it doesn't, the cash flow in year 2 and 3 will be 0 and along the bottom branch, right? So, but nothing wrong. I mean, it doesn't hurt. So I'm gonna copy this, paste here, and then we got, oops. Okay, and then this should be all 3. Now, I wonder why this is not 2000 something. Probability correct. Oh, anyway, the probability is just like this. Now, yeah, because here there's no further probability. It's just if it turns poor, right? And then from year 2, it's gonna be dropped. So now we got, okay, weighted average net present value is now that. And based on that, what is the, so this is, remember, adding a space, right? Adding additional space, at the outset of the project. So with that option, what's going to be the value, net present value with the real option? This is it, right? And what is the without? Of course, without, this is the value without. And then value of the, so then the value of the abandonment option is, of course, this minus this. Right? Then the net of the real option is, oh, this shouldn't be a, with the abandonment option, we have significant, benefit from the option. The option value, this option outweighs the cost by about 120% or 120%. So the decision, this abandonment option must be accepted. I mean, this option must be Did everyone get to the same result?
Yes.
Okay, good. I think only one person got to the same result. Okay.
I got it.
Yes.
Okay, good.
Yeah.
Good. All righty. All righty. So then that's it for today. That's it for today. I'm going to see you guys on Wednesday. We're going to move on to the last topic on Wednesday. Okay. All righty. So take care, everyone. Have a great evening. Okay. And
Thank you,
see,
Professor.
where is that?
Thank you,
All right.
Professor.
Take care.
Thank you.
Take care,
Have a good day.
everyone.
Thank
You too. All right. Let me, so I'm going to stop recording and sign.